Welcome to our special investment report on the highly anticipated SpaceX IPO. This presentation breaks down the structural impact on the NASDAQ 100, dissecting the S1 prospectus, valuation models, XAI integration risks, and our recommended portfolio allocation timeline as we approach the June 12, 2026 listing. SpaceX is poised to become the largest listing in financial history. With the S1 filed and a projected valuation between $1.75 and $2 trillion, it is set to debut as the third largest. Beyond rockets, the company is pivoting to become an AI-driven connectivity giant, aiming for a massive $28.5 trillion addressable market, with nearly half of its prospectus vocabulary focused on AI compute. Looking at the numbers, revenue growth remains strong, led by Starlink, which now generates over 60% of total income. However, you will notice a significant net income deficit, largely driven by aggressive XAI consolidation and high capital expenditure for Starship development. While the financials reflect a massive scaling phase, remember that future growth relies heavily on the success of these new public capital markets. Starlink serves as the company's primary economic engine with over 10 million active subscribers. However, this is currently being offset by the cash drain from the XAI merger. The company has locked itself into a competitive GPU arms race, consuming billions in operating capital, which fundamentally changes the risk profile compared to a traditional aerospace manufacturer. The shift in capital allocation is stark. In Q1 2026, a staggering 76% of CapEx was funneled into XAI supercluster compute, while traditional rocket engineering was squeezed down to just 10%. Critics argue this represents a fundamental restructuring. SpaceX is moving away from its aerospace roots to serve as a utility for Musk's private semiconductor ambitions. The Colossus One supercluster is at the heart of this strategy, operating with 220,000 GPUs at industry-leading cost efficiency. A landmark hosting deal with Anthropic provides immediate, massive cash inflows, while legacy investments from Alphabet and Fidelity have seen enormous returns. This infrastructure is clearly the company's new primary value driver. The NASDAQ 100 is actively adapting to accommodate SpaceX. Because the public float is extremely tight, only 3 to 4%, the exchange has introduced a fast entry provision and a unique 3x cap rule to ensure index inclusion. These changes are significant as they prioritize bringing SpaceX into the index rapidly, even if it deviates from traditional listing standards. Upon entry, SpaceX is expected to capture nearly 0.7% of the NASDAQ 100. This will trigger between $22 and $27 billion in forced buying from passive trackers. Consequently, index managers will be required to execute liquidity arbitrage, selling off portions of current tech giants like Microsoft and Nvidia to balance the index, which could create short-term market volatility. This matrix outlines the inclusion timeline for various major indexes. You will notice that NASDAQ 100 and other trackers are moving quickly, with inclusion expected within weeks of the IPO. This institutional friction highlights a broader industry concern. Index methodologies are being heavily adjusted to accommodate the listing, potentially forcing passive holders to absorb shares at peak valuation. We must also address severe governance red flags. Musk retains 85% of the absolute voting control through a dual-class share structure. Furthermore, the company is invoking controlled company exemptions to bypass board independence requirements and has implemented stringent litigation obstacles that limit minority shareholder rights. Institutional investors have already begun blacklisting the stock based on these concerns. When comparing direct SpaceX stock to an index-based allocation, the trade-offs are clear. Direct ownership gives you exposure to the high-growth AI and Starlink segments, but at the cost of high volatility and zero minority governance. Conversely, a QQQ allocation provides diversified, low-cost exposure, though you must accept that your stake in SpaceX will be heavily diluted and potentially overpaid due to index rebalancing. Our strategy is broken into phases. In the first 15 days, we recommend a no-buy zone as passive inflows create a programmatic price spike. We anticipate a 15 to 20% retracement once this initial buying pressure fades. We suggest waiting until the insider lockup cliffs pass later this year to begin building a consolidated position as the speculative premium stabilizes.